What is a business valuation? If you are raising capital, selling your company, negotiating equity with a co-founder, or preparing for long-term growth, there is one fundamental question that sits at the center of every financial decision. What is your business actually worth? That question is answered through a business valuation, and understanding how valuation works can change the outcome of negotiations by hundreds of thousands, or even millions. What is a business valuation? A business valuation is the structured process of estimating what a company is worth at a specific point in time. It combines financial performance, revenue growth, profit margins, market conditions, competitive positioning, risk factors. The output is not just a number. It is typically a value range, supported by analysis and methodology, that can be defended in professional discussions. That valuation may be used in fundraising negotiations, mergers and acquisitions, shareholder restructures, employee option schemes, tax and regulatory filings, internal strategic planning. Valuation translates business performance and future potential into financial value. Why valuation matters? Valuation directly impacts ownership and control. In fundraising, the pre-money valuation determines how much equity you give up in exchange for capital. For example, if your business is valued at $2 million and you raise $500,000, the investor may receive 20%. If your valuation is $4 million and you raise the same $500,000, dilution drops to roughly 11%. That difference compounds across funding rounds. In mergers and acquisitions, valuation establishes the baseline for negotiation. Buyers and sellers rarely start discussions without financial modeling to justify expectations. For HMRC purposes, valuation becomes a compliance requirement. EMI option schemes, share transfers, inheritance tax, and capital gains calculations all rely on defensible valuation logic. So valuation is not theoretical. It affects ownership, taxation, control, and long-term wealth. Valuation is forward-looking. A common misconception is that valuation is simply based on past profit. It is not. Accounting focuses on historical performance. Valuation focuses on future economic benefit. Investors care about future cash flow, revenue trajectory, market expansion potential, margin scalability, risk exposure. A company that earned modest profit last year, but is growing at 80% annually, may be worth more than a larger business with flat revenue. Why? Because valuation prices future potential, adjusted for risk. The difference between price and value. Another critical distinction is the difference between price and value. Intrinsic value reflects the economic fundamentals of the business: cash flows, assets, and risk profile. Fair market value reflects what informed and willing buyers and sellers would agree in a normal transaction. Investment value reflects what a specific buyer may pay due to synergies or strategic advantages. Price, however, is the final negotiated outcome, and price can be influenced by market timing, competitive bidding, urgency, deal structure, payment terms. A valuation supports negotiation. It does not guarantee the final price. Valuation. Across business stages, valuation methods change depending on company stage. At idea or pre-revenue stage, milestone-based methods such as Berkus or scorecard may be used because financial data is limited. At seed and Series A, venture capital methods and comparable transaction multiples become more relevant. As companies mature and generate stable cash flow, discounted cash flow analysis and EBITDA multiples become dominant frameworks. Professional valuation is stage sensitive. The method must match the data available. What makes a professional valuation credible? A credible valuation report includes more than a headline figure. It typically contains company profile and business model overview, historical financial analysis, market and competitive assessment, application of multiple valuation methodologies, sensitivity analysis, a justified value range. Professional valuations rarely rely on a single method. They apply multiple frameworks and weight them appropriately to strengthen defensibility. That structure builds confidence with investors, lenders, and advisors. How long does a valuation last? A valuation is a snapshot in time. Revenue changes, market conditions shift, interest rates move, investor sentiment evolves. In practice, a valuation is typically considered current for around 3 to 4 months, particularly in fundraising environments. If there is a material change in financial performance or market context, a reassessment is advisable. For formal regulatory or tax purposes, valuations are tied to a specific valuation date. They reflect conditions at that moment, not permanently. Final thoughts. Understanding your company's value is fundamental to maintaining strategic control. Whether you are raising capital, planning an exit, issuing shares, or simply tracking growth, valuation provides financial clarity. It transforms business performance and potential into structured, defensible value. If you would like to see an estimate of your company's value, you can try the free business valuation calculator at www.valuationforyou.com. And if this was helpful, subscribe for more clear guidance on business valuation, fundraising, and strategic finance.